People always come to me when the economy starts to shake and ask the same question. Warren, what's the best move right now before a recession hits? And I tell them something most people don't want to hear. Panic is the most expensive asset on the market. A recession is like a storm over the ocean. You can't stop it, but you can prepare your ship. And if you prepare it well, the storm can actually push you farther than calm waters ever could. When I was a young kid in Omaha, delivering newspapers and saving every nickel, I realized something most adults around me never understood. Downturns don't reward intelligence, they reward discipline. Not education, not talent, discipline. The ability to not do something stupid when everyone else is doing exactly that. Before we get into the practical steps I personally use every time the economy starts tightening, I want you to understand one truth. Recessions make wealthy people even wealthier, not because they're smarter, but because they're ready while everyone else is still getting nervous. And in this story, I'm going to show you exactly how to prepare step by step so a recession doesn't destroy your progress but becomes your opportunity. And the first thing I do before a recession is brutally simple, but almost nobody does it because it requires honesty, the kind that stings a little. I strip my financial life down to the studs and look at every outgoing dollar like it is a potential leak in a boat headed into rough seas. Most people wait until the storm is already overhead before they start tightening their budgets, but by then the water is already pouring in. When I was 32 and running Buffett partnership, I used to sit in my tiny office with a yellow legal pad and write down every expense the partnership had, from the rent to the postage stamps, and I would ask myself one question: if the market dropped 30% tomorrow, would this expense still make sense? Most people think preparation is about stock picking or timing the cycle, but it starts much earlier than that. It starts with eliminating financial fragility. Every recession punishes fragility and rewards resilience. And resilience is built quietly, long before the headlines start screaming. So before I even think about opportunities, I make sure my foundation is bulletproof. I increase my cash buffer, not because cash is a great investment, but because cash is oxygen when everyone else is suffocating. I simplify my bets because complexity collapses fast in a crisis. I refocus on businesses with durable moats, the kind that survive wars, recessions, and management mistakes. And most importantly, I check my psychology. People think recessions are economic events. They are psychological events first. If you lose your head, you lose your wallet. So at this stage, I ask myself the same question I asked decades ago during the 1973-74 crash when the market fell nearly 50%. Will I allow emotion to sabotage discipline? And if the answer is anything other than a confident no, then I know I am not ready. Preparation is not glamorous. It is slow, deliberate, boring. But it is exactly this boring work that turns a recession from a disaster into a decade-defining opportunity. And once this mental reset is done, once the foundation is stable and the fear is under control, that is when the real strategic stage begins, when the foundation is solid and the fear is quiet. That is when I shift into the stage that separates the spectators from the winners. Before every recession, there is a window, a brief moment when the crowd is confused, not terrified yet, but uneasy, and that is where discipline and preparation give you X-ray vision. The average investor waits for the headlines to confirm the recession, but by that time the opportunity is already gone. What I do instead is watch behavior, not news. When businesses with strong fundamentals start trading at prices that imply they are dying. When investors begin selling great companies simply because they need liquidity. When panic starts leaking into the market through the smallest cracks, that is when I lean in. I remember the months before the 2008 financial crisis vividly. I was sitting in my office in Omaha, watching companies with decades-long track records trade like they were lottery tickets. Most people thought the world was ending. But I had seen this movie before many times. In those moments, I do something that looks reckless to the untrained eye but is actually the safest move you can make. I start building a list, a long, detailed, obsessive list of every business I understand deeply, every business with a durable competitive advantage, every business that could survive a recession, a depression, even temporary stupidity from its management. And I assign each business a price that makes it irresistible, a price where the future cash flow justifies everything. Then I wait. I do not chase. I do not guess. I do not predict. I wait like a predator that knows the herd will eventually come too close. And when the panic hits its peak, when the headlines declare the end of capitalism, when people who were bragging about their returns months earlier start asking how to withdraw their money, that is when these irresistible prices appear like clockwork. This is where most people make the wrong move. They think a recession is a time to run. But recessions are the only periods when the financial world becomes honest. They strip away illusions. They reveal who is strong and who is weak. They expose which companies were built on real value and which ones were built on hope. During the dot-com crash, during the 1970s inflation spiral, during the energy crisis, during Black Monday, the same pattern repeated. Noise rises. Prices fall. Fundamentals remain. And that is exactly why I always say that the stock market is a mechanism for transferring money from the impatient to the patient. In a recession, that mechanism runs at full speed. And once you understand that, once you embrace the discomfort instead of fighting it, you begin to see the truth that most investors never learn. Recessions do not destroy wealth. Behavior does. And by this stage in the preparation process, with the watch list ready and the discipline sharpened, the next move becomes inevitable. It is time to position yourself not for survival, but for the kind of decade-defining gains that only appear when the world is afraid. Now comes the stage almost. Nobody talks about because it is the opposite of what fear tells you to do. When the world starts tightening, when layoffs begin and credit gets harder and headlines grow darker, this is when you must expand your opportunity radius instead of shrinking it. Before every recession, I study not only the companies I want to own, but the behaviors that predict how people will react when pressure rises. The truth is that recessions are not economic downturns. They are behavioral stress tests. They reveal how humans behave under fear, how businesses behave under strain, and how markets behave when liquidity evaporates. I saw this clearly in the early 1980s when interest rates hit levels that would give investors today a heart attack. People were dumping perfectly healthy companies simply because they thought the pain would never end. And that is when I learned one of the most valuable lessons of my entire career. The world recovers long before the people do. Markets begin healing while the population is still panicking. Businesses stabilize while consumers still expect the worst. And this lag between reality and emotion is the gap where fortunes are made. So before a recession fully takes shape, I begin identifying what I call high resilience zones. These are areas of the economy where demand does not disappear even in the darkest moments: insurance, consumer staples, payment systems, infrastructure, healthcare services, businesses with recurring revenue, companies selling products people need, not want. And while the crowd chases trends, I look for these boring giants quietly waiting for impatience to push them to irrational prices. But that is only half the preparation. The other half is far more psychological and far more important. Every recession exposes the same weakness in investors. They confuse volatility with risk. They think a falling price means a failing business. They think a turbulent market means a broken market. But volatility is not risk. Volatility is the ticket you pay to participate in long-term wealth building. Real risk is buying something you do not understand. Real risk is overpaying because you were excited. Real risk is expecting a stock to behave like a savings account. And when fear creeps in, people forget these truths. They sell the best assets because they are liquid and hold the worst assets because they are illiquid. They make decisions based on what hurts least in the moment instead of what benefits most in the long run. That is why preparation must happen early. You cannot build emotional discipline during chaos. You build it before chaos. When I was younger, I used to reread the same annual reports dozens of times until the business felt like a living organism in my head. I did this because I knew that someday the market would test me. It would try to shake me out of positions that were fundamentally sound but emotionally uncomfortable. And every recession has tested that discipline in ways no textbook could prepare you for. The 2008 crisis tested it. The 1970s inflation tested it. The dot-com crash tested it. And each time the same formula worked. Study deeply. Prepare early. Act calmly. Ignore noise. Embrace patience. And above all else, trust mathematics more than emotion. Because when the world panics, mathematics does not. And once this mindset is secured and the map of resilient opportunities is drawn, that is when the final preparatory step begins, the shift into strategic accumulation, the part of the cycle where you stop thinking like a defender and start thinking like someone getting ready to take the field while everyone else retreats from it. Strategic accumulation is where everything you prepared for finally converges. And it is the stage that transforms a recession from a threat into a once-in-a-generation wealth multiplier. Most people think accumulation means buying aggressively the moment prices fall, but that is not how disciplined investors operate. Before a recession fully unfolds, I begin positioning myself like someone laying tracks miles ahead of where the train currently is. I do not try to catch the exact bottom. That is a fool's game. I build a structure that allows me to take advantage of every wave of panic that inevitably comes in cycles. Recessions never happen in a single drop. They unfold in emotional phases. First comes denial, where people insist that the weakness is temporary. Then comes discomfort, where volatility grows but confidence remains. Then fear, when people start selling quality assets simply because they cannot sleep. Then the emotional capitulation, where the market throws everything overboard. And finally, apathy, where nobody wants to touch stocks even when they are historically inexpensive. I accumulate in calibrated stages across these emotional waves because doing so forces discipline into the process and removes ego. I remember doing this in the 1970s when the market looked like a graveyard, when inflation was strangling the economy and analysts were predicting a decade of stagnation. While everyone was terrified of double-digit rates, I was quietly accumulating positions in businesses that were still minting cash. During the 2008 crisis, the logic was the same. I was not trying to predict when the housing market would hit bottom. I was identifying which businesses would survive regardless of when the bottom arrived. And when panic hit its crescendo, I deployed capital because the math was undeniable. But strategic accumulation is more than just buying. It is understanding the structural advantages that recessions give to patient investors. In normal markets, great companies almost never trade at discounts that justify massive long-term returns. Competition keeps prices rational. But in a recession, competition disappears because fear paralyzes it. When liquidity tightens and lenders become cautious and investors start hoarding cash, the field clears. And in that moment, if you have cash and courage, you can buy future decades of earnings at prices that make no sense at all in rational environments. I once said that opportunities come rarely, and when it rains gold, you put out a bucket, not a thimble. Recessions are the rainstorms. But most people show up with their hands in their pockets. They are too worried about losing money in the short term to notice that they are locking themselves out of extraordinary long-term compounding. Every recession of the past century has created fortunes because someone was willing to buy what everyone else was desperate to sell. But strategic accumulation requires another ingredient that people often underestimate. You must buy only what you understand so deeply that you can remain unshaken when the price falls another 10%, 20%, or even 50%. If the business is strong, if the fundamentals are real, then lower prices are not danger signs, they are invitations. The price you pay determines your return, but the conviction you hold determines your survival. And survival is the prerequisite for every long-term victory. I learned this during the period after Black Monday in 1987 when the Dow dropped more than 20% in a single day. People were calling it the end of the financial system. But the fundamentals of great businesses had not changed in 24 hours. Only the emotions had. So I accumulated patiently because mathematics was still on my side. And that brings me to the most misunderstood part of pre-recession strategy. The goal is not to predict the bottom. The goal is to be positioned so that whenever the market finally enters its irrational phase, you are not scrambling to respond, you are already prepared to act. Because when the crowd panics, the window of opportunity opens and closes faster than most people realize. And if you are not ready before it opens, you will not be ready when it closes. Strategic accumulation is the quiet battlefield preparation that sets the stage for what comes next. The transition from positioning into decisive action. The moment when you stop waiting for opportunity and begin harvesting it, when the moment of decisive action arrives. It does not announce itself with clarity or certainty. It arrives wrapped in fear, volatility, confusion, and headlines that try to convince you the global economy is collapsing. That is precisely why only a fraction of investors ever capitalize on it. By the time the recession becomes undeniable to the public, the best opportunities are already forming quietly beneath the surface. This is where everything I have prepared converges into a simple guiding principle. Act based on value, never on emotion. When markets enter the capitulation phase of a recession, when trading volumes spike because people are selling assets simply to stop the emotional bleeding, that is when value separates from price in the widest spreads you will ever see in your lifetime. Before every major downturn I have lived through, I studied patterns of forced selling because forced selling is the heart of irrational pricing. Pension funds meeting withdrawal requests, leveraged investors facing margin calls, businesses liquidating assets to stay afloat, index funds selling because money is flowing out faster than it is flowing in. These are not intentional decisions. These are mechanical reactions to pressure. And if you understand this mechanism, you realize that recessions produce extraordinary opportunities not because the world is ending, but because the financial system is temporarily acting like a distressed seller. During the great financial crisis, I saw iconic companies push two valuations that ignored decades of consistent earnings. In moments like that, the world does not offer you chances, it begs you to take them. But decisive action must be rooted in clarity, not courage alone. Before deploying significant capital, I stress test every assumption as if the recession will last longer than expected. I imagine revenue dropping, costs rising, consumer sentiment weakening. If the business survives that mental simulation with its integrity intact, it qualifies. If not, it is discarded. The standard is unforgiving because recessions demand unforgiving discipline. When I invested in American Express during the 1963 salad oil scandal, circumstances looked catastrophic. The company was being buried under fear. But when I examined the fundamentals, the core business was untouched. People were not going to stop using their cards because of one scandal. That distinction between temporary noise and permanent damage has guided me for over 60 years. In the depths of the 2008 crisis, I applied the same logic. Goldman Sachs was being treated like a sinking ship, but its long-term earning power was clear as day. Acting decisively in those moments is not about bravery. It is about recognizing that fear distorts human perception far more than it distorts mathematics. And mathematics is what I trust. When decisive action begins, I think in decades, not quarters. A recession is a storm, but storms pass. Strong companies outlive weak economies. Consumer behavior eventually normalizes. Innovation continues. Population grows. Productivity rises. And businesses adapted to human needs and predictable patterns endure far longer than any temporary downturn. That is why decisive action is not a gamble. It is a logical extension of preparation. And yet this phase has another layer, one that most investors never even consider. During a recession, the real competitive advantage is time. Not timing, but time itself. If you can buy assets when everyone else is forced to sell and then hold them without anxiety or urgency, you possess a power the market cannot beat. Time turns discounted assets into compounding machines. Time converts temporary pessimism into permanent returns. And time transforms every rational purchase made during chaos into a decision that looks brilliant years later. I saw this during the aftermath of every major downturn. Investors who panicked spent years trying to rebuild what they lost. Investors who prepared and acted decisively spent years watching their decisions multiply. The difference was never intelligence. It was temperament. And this is why decisive action is not the end of the strategy, but the beginning of the wealth-building phase that follows. The phase where the seeds planted during the darkest moments begin to grow silently while the world is still recovering emotionally. Because after decisive action comes the part most people underestimate the most, the long stretch of disciplined patience that amplifies the gains and cements the rewards of every smart move made under pressure. The patience phase is the silent forge where real wealth is created, and it is the most psychologically brutal stage because it demands that you do something human beings are naturally terrible at. You must wait while nothing seems to be happening, while headlines still scream danger, while analysts still predict doom, while politicians argue on television about recovery timelines, and while the world around you insists that the pain will continue indefinitely. Patience in the aftermath of decisive action is not passive. It is active resistance against the urge to react to noise. After every recession I have lived through, the period that followed the bottom was filled with doubt, not confidence. In 2009, when markets had already begun their climb, most investors refused to believe it. They were traumatized by what they had experienced and convinced that another collapse was imminent. This emotional scar tissue prevented them from participating in the early stages of recovery, the exact stages where the greatest accelerations of wealth occur. That is why I often say that temperament beats analysis. You can have perfect information, perfect logic, perfect models, but if you cannot sit still during discomfort, those tools are worthless. Patience is the bridge between opportunity and reward. And to practice it effectively, you must have already accepted that volatility is not a signal to act but a test of your resolve. Look back at the aftermath of the dot-com crash. When everyone was still licking their wounds from collapsed tech valuations, strong legacy companies were quietly returning to their fundamental value trajectories. But most investors were too emotionally exhausted to re-enter. Their fear of being hurt again blinded them to some of the most obvious bargains of their lifetime. The same happened after the 1970s stagflation era. Inflation was high, sentiment was low, and pessimism dominated every conversation. But beneath that pessimism were companies with rock-solid cash flows trading at laughably cheap prices. Those who had the patience to hold through the noise saw returns that changed their financial lives permanently. Patience also requires the humility to acknowledge that you cannot force the market to reward you on your schedule. The market is not your employee. It does not respond to your frustration, your fears, or your timelines. It moves according to collective psychology and economic forces far bigger than any individual. That is why I always approach post-recession patience the same way. I remind myself that the seeds of compounding grow invisibly for long stretches before revealing themselves. The early gains after a recession are often slow and inconsistent. A company you bought at an irrational discount might drift sideways for months or even years. But as long as the fundamentals remain intact, the business continues to earn internally, even if the stock price does not reflect it yet. Eventually, price and value converge. They always do. You simply cannot predict when. That is why patience is not the absence of activity. It is the expression of conviction. And conviction cannot be faked. It can only come from deep understanding. People who buy businesses they barely understand crack under pressure because they have no anchor. They are tossed around by headlines, forecasts, rumors, and emotions. But if you understand a business so deeply that you can explain its mechanics like you are explaining the gears of a watch, then no temporary price movement can shake you. During the long climb out of the 2008 recession, I held positions that took months to reflect the underlying strength of their businesses. But because I understood their competitive advantages, their management quality, and their long-term earning potential, I was not bothered by the stagnation. I knew what I owned. I knew what I paid. I knew what it was worth. And most importantly, I knew that time was working for me, not against me. The patience phase also exposes the greatest weakness of reaction-based investors. They get bored. And boredom is one of the most dangerous emotional states in investing because it leads to unnecessary tinkering. People start selling winners to chase new excitement. They jump into speculative ideas because the quiet compounding of disciplined decisions feels too slow. But wealth is rarely built quickly. It is built consistently. And consistency demands patience even when the process feels invisible. The market rewards those who resist the temptation to act without reason. And once this phase of disciplined waiting is anchored, once the emotional dust of the recession has settled, the next stage emerges naturally. The period where the world begins to recover, where confidence creeps back into the system, and where the advantages accumulated during the darkest days begin transforming into results so large that even skeptics cannot ignore them. The recovery phase is when the world finally starts to resemble stability again. But this is also where most people make their biggest mistakes because they misinterpret normalcy as a signal to chase what they missed. This is the stage where the crowd wakes up too late, looks around, sees that markets have been quietly rising for months, and suddenly feels the crushing weight of regret. Regret is one of the most dangerous emotional forces in all of investing because it pushes people to abandon discipline in order to make up for lost time. They start buying aggressively at elevated prices. They chase momentum. They convince themselves that they need to catch up to others, not realizing that this psychological rush often leads them straight into the tail end of the recovery, the portion of the cycle where gains slow down and risks silently increase. Meanwhile, disciplined investors, those who prepared early and acted decisively during the downturn, do something entirely different. They do not chase anything. They simply hold and let compounding do the work because they positioned themselves months or even years before the crowd realized what was happening. I have watched this cycle repeat across every major recession in my lifetime. After the dot-com crash, once the dust settled and tech companies with real earnings began to rise again, the crowd that had been terrified earlier suddenly piled back in at the wrong time. After the 2008 crisis, the same behavior unfolded. For months, the market climbed while people insisted it was a dead cat bounce. Then suddenly, when the recovery was already underway, investors flooded back in, desperate to recover what they had missed. And because they were entering late, they carried a mindset of urgency rather than patience, which made them vulnerable to every minor dip and correction. The true winners of any recession are those who understand that the recovery phase is not for repositioning, it is for reinforcing the positions you already built. During recovery, I spend most of my time reviewing fundamentals, ensuring that the companies I bought during the downturn continue to execute. Businesses do not instantly recover just because the economy does. Some adapt slower, some faster, some reveal new strengths, some show new weaknesses. The recovery phase is where the separation between the good and the extraordinary becomes visible. Companies with durable moats regain momentum faster because their customers, suppliers, and partners trust them even in times of uncertainty. They do not have to rebuild their reputation. They simply continue where they left off. And if you bought them at distressed prices during the recession, the recovery amplifies your returns in ways that shock people who were sitting on the sidelines. But the real magic of the recovery phase is not the rise in stock prices. It is the acceleration of internal compounding. As the economy stabilizes, consumer spending returns, business investment picks up, credit flows again, and companies expand. All of this compounds internally inside the businesses you own, whether the stock price moves or not. And if you stay disciplined through the entire cycle, this recovery becomes the runway that propels your long-term returns to levels that look extraordinary decades later. Yet most investors sabotage this stage because they become intoxicated with the feeling of improvement and begin making unnecessary moves. They rotate into sectors they do not understand. They abandon their original strategy to chase whatever performed best in the early recovery. And they forget that the largest gains often occur quietly, behind the scenes, long before the market headlines acknowledge the transformation. When I talk to young investors, I often remind them that the real measure of wealth is not how you behave when markets crash, but how you behave when markets recover. Anyone can appear disciplined when they are terrified because fear paralyzes action. True discipline appears when optimism returns and temptation grows. During recovery, patience remains the most important asset because it prevents you from interrupting compounding. The goal is not to outperform every short-term rotation. The goal is to let the decisions you made during the recession mature. A recession is where you plant the seeds. The recovery is where you water them. And the years that follow are where you harvest. But patience is not the only requirement here. You must also recognize that recovery does not guarantee smooth sailing. Every recovery includes volatility spikes, policy debates, interest rate adjustments, geopolitical surprises, and countless moments that make people question whether the recovery is real. And this is where your conviction is tested in a different way. Not through fear, but through doubt. Doubt that the recovery will last. Doubt that you made the right decisions. Doubt that you should continue holding. I have lived through dozens of these moments. Every recovery comes with skeptics who insist that the next collapse is around the corner. And yes, corrections happen, pullbacks happen, headlines frighten people, but the deeper truth remains unchanged. Economies recover because human beings adapt. Businesses recover because demand returns. Markets recover because innovation continues. And as recovery strengthens, a new phase emerges, one that rewards those who have stayed the course from the very beginning. The compounding phase where years of discipline finally crystallize into extraordinary long-term results. The compounding phase is where the true magnitude of every disciplined decision made during the recession and recovery reveals itself. And it is the phase almost nobody truly understands because its effects are invisible in the moment and overwhelming in hindsight. Compounding is slow, quiet, and almost boring in the beginning, which is why most people do not respect it. But it is also exponential, unstoppable, and brutally powerful over long periods, which is why it becomes the greatest wealth-building force in the financial world. Most investors think compounding is simply the process of money making more money, but that definition is too shallow. Real compounding is the multiplication of advantages. It is when a strong business reinvests earnings into expansion, innovation, acquisitions, talent, and efficiency, creating layers of growth that stack on top of each other year after year. During the compounding phase, the businesses you bought during the recession begin generating returns not only because the market revalues them, but because they are producing more cash internally, launching new products, entering new markets, and scaling their competitive moats. This internal compounding is often far more powerful than any price movement the market shows. I have watched companies like Coca-Cola, American Express, and Berkshire's own subsidiaries grow not because of market enthusiasm, but because their underlying business engines kept improving quietly for decades. That is the essence of compounding. It rewards patience and destroys impatience. And yet most investors sabotage themselves precisely in this phase because they misunderstand how exponential growth works. In the early years, compounding feels insignificant. A position might rise 10%, then stagnate. It might deliver modest earnings growth that feels underwhelming. And because investors crave excitement, they jump ship early, trading long-term compounding for short-term stimulation. They forget that the largest portion of compounding always happens later, often decades later, not in the first or second year. Consider the mathematics. If a company compounds earnings at 12% annually, the first 5 years look unimpressive. But years 10 through 20 become monstrous because each percentage gain is applied to a base that has grown dramatically. For example, a dollar compounding at 12% becomes $3 after 10 years, but nearly $10 after 20 years. And this mathematical explosion accelerates even more when a recession allowed you to buy the business at a steep discount. You are not just compounding growth, you are compounding undervaluation correcting itself. This dual compounding effect is why the greatest fortunes in history were not built on speculation but on uninterrupted ownership of great businesses over long periods. But the compounding phase has another layer, one most people never think about. When you hold strong businesses for decades, the world around them changes dramatically. Technology evolves, demographics shift, consumer preferences transform, and entire industries rise and fall. Weak businesses crumble under these changes. But strong businesses adapt, evolve, and expand. And because you are holding them through these transformations, you benefit from innovations you did not even predict. This is why I always tell investors that you do not need to know the future to benefit from the future. You simply need to own businesses that will survive it. Compounding is also psychological compounding. The longer you hold a great business, the more you understand its patterns, leadership, strengths, and market behavior. That understanding builds emotional resilience and makes it easier to withstand future volatility. You become comfortable with temporary declines because you have seen the business recover before. You become immune to sensational headlines because you know the company's history. This psychological compounding is just as important as financial compounding because it protects you from panic decisions in the next downturn. And make no mistake, there will always be another downturn. Every generation faces recessions, crises, bubbles, and shocks. But if you hold great businesses bought at sensible prices and let compounding run uninterrupted, every cycle becomes fuel for larger returns. I have seen this over and over again. The dot-com crash created opportunities that compounded for decades. The 2008 crisis created opportunities whose returns are still accelerating today. Even the painful recessions of the 1970s produced gains for those who were disciplined enough to stay the course. The compounding phase, however, demands one final ingredient. You must protect your portfolio from yourself. Investors are often their own worst enemy, selling too early, overreacting to short-term noise, chasing new trends, or replacing strong businesses with exciting stories. But if you truly want to experience the full force of compounding, you must allow time to do the heavy lifting. You must let the roots grow deep before expecting branches. Because when you do, the long-term results become almost surreal. What looked like a modest gain in the early years becomes a life-changing outcome decades later. And it is here, in the heart of compounding, that the final phase of the recession strategy emerges. The phase where you elevate from simply surviving cycles to building a legacy that outlives every economic downturn. And that brings us to the final truth. The truth that ties every phase of this cycle together, from preparation to accumulation to patience to recovery to compounding. The truth I have watched play out across nearly 9 decades of market history and thousands of human stories. The truth most investors never fully grasp until it is too late. Wealth is not built in moments of comfort. It is built in moments of courage, discipline, and clarity when the world feels uncertain. Every recession tests you in ways that numbers alone cannot capture. It tests your patience, your temperament, your ability to stay rational when everyone else is emotional. It tests whether you truly understand what you own or whether you are simply renting confidence from a rising market. And when you pass those tests, when you stay disciplined through fear and remain calm through noise, the rewards extend far beyond financial gain. You gain something far more valuable than money. You gain mastery over yourself. Because in the end, the market is not your opponent, your emotions are. Fear, greed, impatience, doubt, envy, frustration, all of these internal forces try to pull you away from rational decision-making. But when you learn to manage them, when you build systems that protect you from your own impulses, you reach a level of clarity that transforms not only your investing but the way you think about time, opportunity, and the cycles of life. I have lived through wars, inflation shocks, technological revolutions, political chaos, speculative bubbles, financial crises, and downturns that seemed at the time like the end of the economic world. And yet the same pattern always emerged. Those who panicked paid the price of their panic. Those who chased trends paid the price of their excitement. Those who waited for certainty paid the price of arriving too late. But those who prepared early, acted decisively, held patiently, and let compounding work quietly behind the scenes, those were the individuals who built fortunes that lasted generations. That is why the best strategy before a recession is not prediction but preparation. It is not about timing the cycle but understanding human nature. It is not about beating the market, but aligning yourself with the few timeless principles that the market has rewarded for over a century. By what you understand. Pay sensible prices. Hold longer than feels comfortable. Stay rational when others are emotional. Trust mathematics over headlines. And allow time to magnify every disciplined decision you made when the world was afraid. Because recessions do not create wealth or destroy it. They simply transfer it. From the emotional to the rational, from the impatient to the patient, from the fearful to the prepared. And if you follow these principles, if you treat every downturn not as a threat but as a doorway, then the next recession will not be something you fear. It will be something you are ready for, something you use, something that becomes a defining chapter in your financial story. In the end, the greatest opportunity of a recession is not the stocks you buy or the returns you capture. It is the investor you become. And that version of you, disciplined, calm, clear thinking, long-term focused, that is the version who wins every cycle, no matter how many storms the world brings next.